Good morning, traders. Today is March 4th, Saturday. This is the Custom Metals Index. Today we're going to go over the metals market and what looks like a potential capitulation bottom setting up. You may recall over the past couple of weeks I talked about how these flagging formations right in this area would likely become support. And we have support going back over here. We have support and resistance coming back over here. Then we have the apexing flag formation here. We have the broad depreciation cycle in gold taking place right here. We've had a nice rally up out of this, and it looks like we're setting up with what may be a fairly solid capitulation bottom, possibly moving up into new all-time highs before the end of 2023. I think there's a really good possibility that this index could move up into the 460, 480 area, which would put gold up into the 2100, 2150 area over the next 6+ months. So let's take a look at some of the data here. So this is the Custom Metals Index chart. I'm going to go back here to the Custom Metals Trend Index. This is a different look at metals. You can see how the depreciation cycle, which came down and established a new low over here near the end of 2022, on this chart back over here, did not establish a new low over here. This is because this is a proprietary index measuring actual momentum trend related to other instruments. So I've highlighted this, that we see a fairly solid move of about 4,500 points in the gold market on a regular basis. So hypothetically, from down in this area, about 7,000, up to about 11,500. Do the math, that's about 4,500 points. Coming back down here, around 8,750, up to this high, around 12,800. It's about 4,500 points. I believe the next move here, right around 9,900, could put us up into the 1350, possibly 1400 range, way up over here, which is where I've drawn this green line. So now we need to look here at what could be driving metals trends. So we're looking at a couple of things. Let's go back over to the next chart. First off, real estate. U.S. and global real estate may enter into a protracted decline. Now, I'm not saying a collapse. I'm calling it a decline. We have not seen this type of hostility, and I've mentioned this many times. This is the hostility index for U.S. real estate. We have not seen the markets be this hostile related to pricing factors in a number of years. So in 2008, back over here, you can see we got to this peak level, rolled back downward into this lower channel. Over here, 2012, 13, actually 11, we got up into this upper channel again, then rolled down to this lower channel. 2015, 16, we got up into this upper channel and then rolled back down. 2020, during the pre-COVID area, we got up into this upper channel and rolled back down. Now, this is partly due to Feds adjusting interest rates, but where we're at right now, you can see in 2021, pricing factors became a big issue. And in 2022, when the Fed started raising interest rate, it pushed us way up here into this hostility range. This is the highest level we've seen in more than 25 years. My belief is that real estate will migrate downward or revert downward back down into this 250, 270 area, maybe even deeper, depending on what happens. I think this is going to take about 24 to 36 months of a moderate global decline. And the real issue here is, again, ladies and gentlemen, the settling or resolving global debt and credit events. So we'll see if this is a orderly unwinding or an orderly unwinding or a disorderly unwinding of excessive credit debt events. But again, fear cycle could be driving metals into an upward cycle, which happened again way back down over here in 2004, 3, 4, 5, 6. Now, we haven't seen that same type of real estate pricing, but at this point, I think metals have are reacting to the longer term fear cycle of a global credit event. Could be a global banking event, could be just an unwinding of corporate debt, bonds, could be a settling or resettling of expectations over the next 24 months. But I believe metals could be capitulating near this 1850, 1860 area and likely move up to 2100, 2200 over the next 6 or 7 months. So now the gold custom index, cycle index, is showing again depreciation and is starting to move back to the upside. This is really accumulation in this area. So when gold is moving higher and this accumulation or this cycle trend index is staying down here near these low levels, this is showing us essentially that we're getting some moderate accumulation at this phase. You could argue we've had some distribution in gold, but I'm viewing this as accumulation. We would want to see this start to move back up into the 35, 40, 45 area on real accumulation. That's what we're looking for towards the end of this year and into 2024. And now we're going to get into the accumulation cycle phase. This is for the general market. You can see we've had a bit, this is a monthly chart. So March is starting out here, a little bit of a green bar. That's okay in my opinion. You can see we've rolled over here and we've stayed in a flatlining area here. What this is telling us here, again, ladies and gentlemen, is when we get into an uptrend, as you can see here, and particularly back over in this area, and then back over in this area, we start to see a broader price decline. So as long as we stay below this blue level here in this accumulation phase index, I believe we're going to see the U.S. markets stagnate and kind of trade within this range. So hypothetically, we're in a kind of a sideways flagging formation. We're about 18 months before a presidential election. And I believe, ladies and gentlemen, that the U.S. markets are going to continue to be the best alternative investment across the globe until the revaluation phase completes. And that's probably going to be after or closer to the 2024 presidential election. There's a lot of uncertainty that takes place in the election cycle, and that typically leads the market into a sideways kind of a channel. We could see some volatility. We could see some sort of a credit event, particularly overseas. I think we could see some broader credit event take place over the next 24 months. But overall, I believe the strength of the U.S. dollar, the strength of the U.S. economy, and the ability to continue to move assets away from risks into a strong U.S. economy, strong U.S. assets, and U.S. dollar-based assets is going to provide some real opportunity for the U.S. market going forward. So I believe that's the end of this direction. Let me go back this direction. Real estate, as I mentioned to you, may become part of an issue. So understand that watching the real estate market, and you can get this on my website, MENT.com, right here, we're seeing very huge increases in price reduction activity. We're seeing a moderate increase in price listings. You can see this line here is price listings. It's now up almost 65%. Again, 67% right down here. We are seeing a dynamic that we have not seen in probably 7+ years. You can see going back to 2018 here, the actual price reduction activity was very minor. You can see here the actual new listings count was tanking. This means that the listings that did come on the market got bid up and bought very aggressively. Now we've changed directions aggressively. What we're trying to see here again is how dynamic this market moves, whether the bottom falls out or whether we find some support. This is the next set of metrics. The heat rank is weakening. You can see it's been weakening throughout most of 2022. The tightness index has collapsed down to minus 100%, came back up just a little bit last week. The real estate inventory strength, which is a measure of how strong inventory valuations are, have been declining throughout most of 2022 and into early 2023. I believe this is going to move down to a -7, -10%. And then we started to see some real solid blips in seller desperation. This is a measure of are we going to see sellers become more desperate in trying to get out of their houses, which could lead to a wave of foreclosures. So as we move forward, we have to watch what the market is actually doing. The U.S. valuations trend index is hovering down around this 53 area, these lower areas. This is good. This does not indicate that we're in bubble territory. This does not indicate that we're in excessive declines. Excessive declines would be down below these midpoint areas. Let's call that in the 47, 48 range. What we're looking for, again, ladies and gentlemen, is 8 to 12, maybe 18 months of sideways consolidation where the U.S. global markets resettle. For those of you who lived through the 70s and the 80s, where I have out here in California, I want you to remember that a resettling event with high interest rates will likely lead to a number of business closures, a number of individuals and corporations addressing excessive debt credit issues. It will lead to a revaluation event of assets. If you remember back in the 70s and 80s, everybody kind of watched their P's and Q's. I actually asked my father about that. Thank God he's still alive. And he said that, there were a number of businesses that went under in the 70s and 80s because of the high interest rate. And that is something that could happen again today. Or over the next 16, 18 months. I believe we're going to see, because of the excesses that have taken place, which you can see back over here, I believe we're going to see at-risk nations throughout the globe more at risk of having some sort of a default issue versus U.S. Industries and corporations. But I believe it is very likely to happen over the next 12 to 18 months where consumers and corporations and governments address debt issues, credit issues, in trying to address these revaluation events. I believe that commodities, general commodities, will weaken over time. Oil will likely weaken, lumber will weaken, copper will weaken, others will weaken. There is still demand for certain raw commodities, for example, in industrial use, medical use, medical equipment use, car use, things of this nature, electronic vehicles. But I believe we are in a resettling phase. So the next 10 to 18 plus months are likely going to be more of a resettling phase than anything else. And again, that points us to a sideways channeling type of market, likely staying above these recent October lows and likely staying below the early 2022 highs. This is going to be the February, March, April highs of 2022. We're going to be staying probably within this range throughout 2023, maybe moving higher in 2024 up to new highs in the U.S. stock market. But as far as gold is concerned, gold is starting what could become the next big move up to 2100, 2200 or higher. So be aware, gold is going to start to act as a very solid hedge, probably reacting better than the U.S. dollar at this point over the next 18 months. Okay, guys, follow my research. Pay attention to what I'm doing. Come out and visit me on MENT.com. Oh, there's one other thing I wanted to show you. Sign up for my Expert Growth membership. All of the details I provide are here for you. It's very important that you understand what's going on and taking place in the market. And lastly, I've been trying to get this this chart set up for everyone with TradingView. TradingView has recently indicated that I have done something wrong in publishing the script. So I'm trying to figure out what I did wrong. But ideally, I'm going to try to figure it out, publish this script, support TradingView, and figure out how to get this into the hands of everybody who needs it. It is not perfect, but it is a great tool to help you understand where we're at in the cycles of market trends. All right, guys, that's it for now. Follow my research. Talk to you later.